but I'll start with a little story. On my last day of my attendance in the master's program, I was in a policy course with the associate dean that was the instructor for the policy course, and we wanted to know what's the takeaway from this whole program. Very last day, feels like it just happened last week in some cases, and he said, you learned all these tools, you learned all these concepts, you practiced some skills, but what you need to understand is when you get out there, you need to know the business. You need to know the business that you're in. And I never forgot that. And the reason why I'm telling you that is that, I've done a fair amount of consulting in my days for federal development and community futures development corporations throughout Ontario, and then other things. I've done many business plans with small and medium-sized businesses. And what it comes down to really know the business, you have to understand what gets measured, gets done. You have to understand, the financials of the organization. And what I found with all the work that I've done, there was only a small percentage, especially of business owners, that really knew their financials and really could have insights as to how to grow that business and deal with the issues that they have. So that this topic is really important. It's probably one of the more important aspects or topics in this course, and it really hones in on management principles. I mean, if you don't know your business, you're never going to be very successful, going forward, making this work for yourself. And so in topic 6, we not only explore some of the areas of financial management, but also a couple of ways, how do you finance your business? And there's some things there that I could tell you about, having experience on boards in the credit union system in Canada. And then how do we manage risk? And at one point in time, managing risk was something, that the audit department did, in accounting. And in today's world, everybody has a part and is responsible to manage risk because of all the many risks and the complexities of the business in today's world. And we're going to calculate financial ratios in this course. And by the way, there's 15 financial ratios we're going to cover in this topic. And lo and behold, those 15 financial ratios you're going to have to calculate for the group cupcake assignment as well. So tune in and so that in this particular webinar, we're going to cover what you need to know for the participation activities of 6A and 6B, which are building blocks, again, for the cupcake assignment. And I wanted to remind you as well is that because of the test last week, I did record topic 5 and sent a notice out to everyone that the video of topic 5, which does cover topics, the topic 5 participation activities 5A and 5B, but also covers many of the key concepts that you should explore in terms of studying for the test. Right, so that's out there as well. It's on the RDP course channel that I created, and the link is on announcements. So you could go into announcements and get the link to topic 5, and for that matter, all the other topics that we covered. All right, so that's where we're going to start. I want you to really understand these financial ratios, and I've added some additional materials and links so you can go to some documentation. There's all kinds of documentation on the internet, not alone in the course itself, to be able to understand these. And again, you always go back to the videos that Professor Powers has provided you in these topics, and she covers many of those items as well. And in the cupcake assignment, you're going to have to calculate 15 of those ratios that we're covering, and understand where they came from. And that's where we're going to take you here. All right, so it's sort of a building block session. And if you do have any kind of questions, I'm kind of watching my my chat so that you can chat. But if there's any pause in my talking, just chime in, unmute, and ask your question. And all these questions are so important because your colleagues can benefit from the types of questions that you ask. It's not just you that has a particular question. All right, so I'll just get started. But before I get started, though, are there any questions at all about how we're doing? Okay, so with that in mind, can I just maybe see a couple of, thumbs up that we're ready to go? Okay, great, thanks. Okay, so I'm just trying to get, I've got someone in the lobby here and I'm trying to, okay, there we go. Okay, let's get started. So, I've always tried to introduce a little bit of lightness, I guess, in the course, but there's more than just curriculum and learning concepts and practicing them in the course. There's other aspects that will make you a bit better business practitioner, and one of them that I want to kind of hone in on is in my helpful hints. Hopefully, I'm trying to do this on a weekly basis. Is about mindset. And just let me tell you this about mindset is that, did you know, right, in high school, the people that score at the C level and continue on to university and working in a career are, in most cases, just as or more successful than the A students and the B students. And why is that? It's because of mindset. And there's an author called Carol Dweck, and I've got the link down here where you can actually go to the, there's a 2-page summary on what Carol Dweck talks about, and she talks about growth mindset and fixed mindset. And what it is that normally these people that score at the C level, they know what failure is all about, and they know how to deal with failure, how to learn from it, how to accept criticism, how to get beyond some of those failures to be successful, and that's all part of being in terms of growth mindset. But excuse me, and I've seen this personally. When I first went to college, I saw some A students from high school just going sideways. And why is because they couldn't accept the fact that they're going through some challenges because they always kind of figured it out, and then they they either shy from it or they rationalize why they're not succeeding instead of knuckling down and really trying to deal with what their challenge is and learn from it. And so mindset is a very important thing, and it allows you to focus. And focus is really important. You can find a lot of people that are very intelligent and very capable, but if they're going after too many things and not really sticking to what the big prize is and working towards that big prize, they can never really get to where they're going. So here, sorry, I've just admitted people here. So work, the mindset can affect your work ethic. It can get you away from the important things. So and it can it gets you away from the unimportant things, and then it'll allow you to handle stress better. It'll affect the productivity in your business. It'll help you solve business problems faster. It'll affect your relationships. It can affect the business decisions that you're making. So it's really key. So I've left this link right here on the slide. And, if you're curious, just click in. I think it's about a 5-minute read. But if anything, take a look at what Carol Dweck has to say. She's a PhD psychologist out of California. She's written this book called Mindset and the New Ways of Success by having this growth mindset. So it's a very interesting piece. So I'll leave you with that. If you have any questions, you can email me and we'll go from there. So let's get right into week 6 deliverables. You've got participation 6A and 6B. And what I want to say right now is that this course basically was given to me. It's the second term that I teach it, and I want to make it mine. And I know that there's all kinds of information in this course. And so how I'm really starting to make this change is really providing these commentary presentations. And I will update things that need to be done in these presentations. So what I'm asking you to do is, don't just look at what's on Blackboard when you come to do these participation activities, because I've elaborated on them And I've given you more information to be able to be more successful in doing this. And again, it's no secret, you know, participation 6A and 6B, whatever you do to complete that as a group, you know, keep that material because you're going to be able to use your calculations, you know, any kind of framework that you put together to work on things in the group cupcake assignment. And that's why I ask you right here, download that assignment as a group, you know, even as you're working through these participation topics so that you can see what you're going to be asked, and then you'll be able to learn and apply things right off the bat in these participation activities. Excuse me, okay? So and not only that, you'll see in the next 1 or 2 slides, I've actually copied a section of the group cupcake assignment description on question 6 to show you how relevant these participation topics are. One notice that I want to let you know is that, you know, your individual project, manager style self-determination, that's due on Friday. I'm gonna slide that due date to Sunday, all right, to give you a chance, and mainly let you know as well is that I won't start marking that till the end of reading week, so that you know that that's the case. But I'm giving you a few more days to get that in. And again, it's really important that you read, you know, the entire description, especially the front end, to show you how to organize that, to help me help you in terms of help me navigate your paper. I guarantee you'll get a better mark if it's totally organized and it's numbered. You know, it's numbered for the questions. I know which questions you started and finished, and with subheadings and other things that could help me, you know, figure out what you've talked about and you've done your due diligence in terms of what the assignment is asking you to complete. All right, so 6A. So we're going to ask you to look at. Let me start over again here. So we're gonna get you to do some stuff there, and I've got them specifically. So let's start with this. So 6A and 6B will help prepare the group for the group assignment, like I said. And this is the information that you need to use to do 6A. In 6A, you're going to have to calculate cost of goods sold, and you're going to have to calculate gross profit, and then you're going to have to comment on how can profitability be improved, you know, in relation to this gingerbread house business. And so I've given you, you know, the cost of the materials, and then you'll have to figure that out. I've given you the cost of labor, and this is, you know, the materials. That's you know, that's a direct cost. The labor is direct cost, and then I'm telling you that your company sold 60 gingerbread houses, and when you go to the formulas, you know, you had nothing in inventory and you sold everything, so you have nothing left in inventory when you're going to do this cost of goods sold calculation. Now in 6B, you're going to have to understand, you know, what is the, you know, the KPI for the organization and what a KPI is, and I'm going to be explaining that in this webinar. But the key performance indicators, what is it that you could measure and to get a sense of, you know, how you're doing and how you could improve, you know, to answer that question, how can you improve profitability? All right, and then what is a reasonable production goal? And we're going to talk about balanced scorecard in this webinar, and I'm going to show you how KPIs depend on what goals are set, and when we get to that piece, I'll show you how it all comes together. All right. So just again, to make this relevant, when you get to the group assignments on cupcakes, if you look at question 6, look at what you have to calculate. Costs of goods and profit calculations in terms of cost of goods sold, costs of goods percentage, cost of goods sold percentage, gross profit, and gross profit margin. And the whole thing is, if you don't calculate cost of goods sold properly, then when you calculate cost of goods sold percentage, it's going to be wrong, and likely gross profit is going to be wrong, and gross profit margin is going to be wrong. So I want you to pay attention to how we calculate costs of goods sold in terms of manufacturing. Okay, you're actually making cupcakes. That's a manufacturing process. And just like you're making a gingerbread house, that's a manufacturing process. So you have to include direct labor, okay? And then costs of goods sold compared to the benchmark for the restaurant industry. I'm going to give you the restaurant industry target, for different calculations, and you need to compare them. So when you compare your answer of cost of goods sold with the average cost of goods sold for that industry, what you're actually doing is benchmarking, and I'm going to talk about benchmarking and define that for you in this webinar as well. And then again, you're going to create this balanced scorecard, with 3 key performance indicators, so you don't have to do many of them for the organization, and give some rationale for focusing on these 3 KPIs and the rationale for choosing those 3 KPIs. So again, what we're doing in 6A and 6B is really setting you up here, to do the cupcake assignment. And that's why it's so important that you get working with your group right away, figure this out, and you'll be 80% there when you come to do the group cupcake assignment. Okay, so 6A, you're going to calculate the cost of goods sold, you're going to calculate gross profit, and then you're going to answer this question: how can profitability be improved? So we're saying, okay, well, how can I do that? I don't know very much about the gingerbread house business. So this is why I put this link on here. And it's an article on ways to improve productivity in food manufacturing. So it's going to give you some general conceptual areas to look at to improve productivity. And guess what? When you improve productivity, you improve profitability. Okay. So that's some help. Now, I also want you to use your creativity and think about how other reasons. I mean, one of the obvious reasons or obvious solutions to increasing profitability is reduced costs. And it's no secret that businesses, when they want to reduce costs, the first thing they'll look at are administration costs. By the way, those are called indirect costs. All right. Why? Because, let's give an example. So let's just say that, they have, 300 people. It's a large company, and they have 300 people in their human resources department. And if they could figure out how to mechanize some of those processes, they could probably reallocate some of those people or reduce the costs right there and then, and it won't affect the production of the company, because they're looking at administration costs. And then you start working from there into, the other functions to see how you can improve that. So there's very many ways that you can improve profitability, in any kind of manufacturing operation or service operation for that matter. So that's the first part. So have a look at this article. That's the short link to it, and that will allow you to do that. So here's where I want to make the point, and especially what I found out from the last term is that many of the students didn't use the correct cost of goods sold formula. And there's 2 ways of approaching that. And I'm just going to go to the next slide to kind of show you this and then flip back because this comment right here, which is in bold and it's in your cupcake assignment description, is going to keep you on track. So what we're doing is we're looking at, because it's a gingerbread house, we're looking at a manufactured good. And the cost of goods sold formula for a manufactured good is beginning finished goods inventory, which in your case now is 0. The cost of goods manufactured come down to the cost of raw materials and the cost of direct labor. All right, and that's what this is. But if you're a Costco, right, like a wholesale producer, say, you don't use this cost of goods manufactured. You just replace this with purchases. So they don't have any direct labor sales or direct labor associated because they purchase those items to resell. So your formula for cost of goods sold on the resold item is beginning finished goods inventory plus purchases minus the ending finished goods inventory. And that's key. And so for the gingerbread house participation activity, all you need to worry about is the information that I've given you in terms of direct labor costs. And let's just review that. What I've said here, in terms of direct labor costs, it's 2 minutes of direct labor for one person to create a gingerbread house at 33 cents a minute. Okay, that's all you need to do for the gingerbread house area in terms of understanding, what the direct labor is. And then you have to incorporate the direct materials, to make that, what materials were needed to create that one gingerbread house, and that's 3-gram wafer crackers at 10 cents each, which is a total of 30 cents, and then 1 juju at 1 cent each. And it's really to try to simplify the operation so you get this, okay? But here's where it gets a little bit different, okay? In terms of calculating the cost of goods sold in the cupcake assignment, you can see that in this area, those two people went to a farmer's market booth for 3 hours for each of the 20 days of the season, which is direct sales labor cost. So you not only have to incorporate direct labor, to make those cupcakes, you have to incorporate the direct sales labor cost. And the thing is, there's a difference. Like in most cases, like say with Costco, the sales aspect is an indirect cost. That's how they bring that together, and that's how they allocate it. But in direct sales costs, the fact that these two people who made those cupcakes are going in, if they went for 4 hours, they'd sell more cupcakes. And that's what this bolded explanation says. Direct expenses, unlike indirect expenses, will vary proportionally to the volume of items you sell. The more you sell, the higher your direct expenses. The less you sell, the lower your direct expenses. So if they wanted to sell more cupcakes, they spend more hours there, and that's a proportional, direct labor expense, and that should be accommodated. All right, so it's a long-winded way of, get this one right so that you can get the rest of these right. Okay. These next two slides are basically just a reinforcement of what I'm trying to say so that you can get a sense of what this is all about. And oh, by the way, if you listen to Professor Power's video on calculating, you can go through that and learn a lot from what she has to say as well. Okay, so again, this is a second slide. And then understand that cost of goods sold is also referred to as cost of sales sometimes. And again, cost of goods sold excludes indirect costs such as overhead and indirect labor of sales and marketing. So that's the way you look at it, and you can go from there. So then that's the first piece. You calculate cost of goods sold. And now we want you to calculate cost of goods sold percentage, and that's the calculation you did on cost of goods divided by sales, right? So I've told you in this piece, let's go back to this. I've told you your company sold 60 gingerbread houses. So in the gingerbread example, say, that's 60 times $3. That's $180. So your sales is $180. And then you've calculated your cost of goods sales over overall sales. And then that will give you a percentage, if you, times 100 to get the percentage to get this figure. All right. The next one now, you can see that, this cost of goods sales, if you don't get that right, you're not going to get the next ones right. If you want gross profit, then you look at the sales again, and then with the gingerbread example, 60 times $3, $180 minus the cost of goods sold that you calculated. And then, to calculate gross profit margin, which in most cases is just called gross margin, you look at, sales, And again, gingerbread example, 3 times 60, which is 180 minus cost of goods sold that you calculated for those 60 gingerbread houses, and then you divide that by, again, the overall sales revenue of 60 times $3. So percent of every dollar of sales that is left over after the product has been made or service rendered, and if you added gross margin plus cost of goods sold, that would equal 100%, and so that gross margin must cover overhead, financing costs, and taxes and profits. So that's where that's going. Okay, so you've got this now. We're into 6B, and what we want you to do now is to pick a few KPI, key performance indicators, for this. And again, this is one of the areas is this article will give you some insights to pick out key performance indicators, and then you're asked, well, what should be the KPI for the organization? The most crucial one for building gingerbread houses, and what's a reasonable production goal? And again, I'm going to show you how KPIs tie into production goals, and just after the next few slides. And then how can you improve profitability? Again, going back, to that article to help you out in figuring that out. So again, I want you to use this balanced scorecard template, because you're gonna, and I want you to use it in the cupcake assignment as well, so that I can see a good picture of everyone doing it the same way, and then I know if you've done it right or you need some help there. All right. But for the for the gingerbread house participation activities, I really only want to see things around the finances and the process. We haven't talked about customers, we haven't talked about learning and growth. And again, I'm going to get to those categories as we get there. You can get this template, go right to this my Google Drive and pick up this document to fill that out. Cool. Okay, so let's just talk about key performance indicators right now. And so what are they? So they're quantifiable measurements, and they're used to gauge a company's overall long-term performance. And I'll repeat myself, I guess, in terms of understanding, how to look at key performance indicators as a business manager or business owner. Well, they're unique to, the vision of the organization. So if you're the owner, they're unique to where you really want to take this business. Whether you want to make it really grow, or you want to build your brand or whatever, your KPIs based on the vision focus, will change, because it's really to get you, to the end result the absolute outcome that you're looking for if you achieve that vision. And so you can see that in some cases it could be revenue per client. And so let's talk about Amazon. Have you ever, you buy an item on Amazon, and the first thing that happens once you've selected that item, something pops up and it says, oh, the people who have bought this particular item, they've actually purchased item B and item C. Well, what are they trying to do? They're trying to increase the revenue per client KPI in their organization, right? So that's how it's coming out, because that's a key focus. They want to grow that company, and that's one way that they can look at it, and one way to really see the results of their efforts, to know if their algorithms are working fine, their marketing strategy is working fine. So it has an impact. It shows the impact of some of the functions that they're focusing on to be able to to get you to increase their revenue, right? Just revenue growth itself. Here's the key one. So in today's world, if your business is not increasing your revenue year over year, you're losing money, all right? Because just like death and taxes, every year your expenses go up, and if your revenue is not going up faster than how your expenses are going up, well, then you're losing money, right? So and you're not making the profit that you want to. So those are the kind of things. So there's other things like profit margin or client retention rate, or customer satisfaction score, and current ratio, and debt to equity ratio, and accounts payable. These are just some of them. But again, it depends on who you are as the business owner, or who you are as the business leader, what the vision of the company is, the type of company, because each companies that are in the same business have different aspirations. And then it depends on what industry you're in and what barriers and challenges you have to overcome to be able to be successful. You know, how the government treats that industry, those kind of things. And we're gonna talk about, profit margin. So, in the general retail area, an average profit margin is about 30%, 0.30. And in other industries, the profit margins are like 50 or 40%. Like in software, they're like 60%, because software, you spend a whole pile of development money, but after that software is basically built, then you just have improvements to make. And so that the cost of those improvements is very little, and you're still increasing your sales. So the margins in those industries are quite higher. So you need to understand that as well. And then I always said customer satisfaction is what we call table stakes. But if you really want to look at how you can grow your company, you want to look at customer loyalty. And the thing is, the KPI for that, and you don't need to know this for the test or anything, is Net Promoter Score. And if you measure Net Promoter Score, then you're really going to measure the ongoing loyalty and advocacy of your customers to help you build that business. So those are a few things to know about that. So now what I've done is I've actually and just luckily I came across this eDoc, and you can go to this. Here's the link. It's on my Google Drive, and it will tell you what kind of KPIs that are always looked at, and then how it ties into the vision and the mission and all these things. And so it's a really good book to be able to help you nail those KPIs for your exercise, and then moving forward with the other assignments. Okay, so now we're just starting to get into balanced scorecard, and here's where this little piece right here is all about the balanced scorecard. And what I'm telling you here is that you financially manage through these 4 components. And what I'm going to do? I'm going to go right to the balanced scorecard so you understand what this is all about, and then I'm going to come back. Okay, so let's go to the balanced scorecard. Okay, so let me tell you just a little bit about where the balanced scorecard started from. It's probably about 25, 30 years old now. Back in the 1970s, most organizations were rewarding what they call top-line revenue. It was all about making more sales. And what they were finding is that because of the incentives, just for one thing, people, that's all they were focusing on, making sales. So they were making sales, and maybe the customer wasn't satisfied with the products or services, or they're making sales and really the company couldn't produce some of the items because the salespeople were hyping the product and promising more than what the product could actually do, or the service could actually do, or promising deliveries that the organization couldn't meet. And so what Kaplan and Norton at Harvard University did was they said, we need a balanced approach. It just can't be financial. It can't be just sales. It's got to be other things. So they came up with excuse me, these 4 categories. I'm just going to take a bit of a drink here. They come up with 4 categories: finance, customer, internal business processes, and learning and growth. And they thought if the company's people were rewarded on all those 4 areas, what would happen is they'd everybody would be able to contribute to a great product or service for the ultimate customer. And that's where that started. And learning and this balanced scorecard was mainly built for businesses, And it was so successful that even nonprofits and governments are using Balanced Scorecard now to be able to guide their measurement processes. What gets measured gets done. So let me show you, this piece. So here's what it looks like, and here's those 4 areas. The financial part, the internal business processes, learning and growth, and customer. And as this approach is being matured, they're really starting to call it now organizational capacity, because that's really what it is. So what learning and growth is, it's that, let me read this: to achieve our vision, how will we sustain our ability to change and improve? Meaning, how can they focus on their employees and their organization to be able to improve it structurally, develop their people, encourage innovation. This is all related to organizational capacity, right? And oh, by the way, organizational capacity translates into competitive advantage as well. So that's one way of looking at it. And then the customer, how to achieve a vision, or how should we appear to our customers, in terms of satisfying them to the point where they become loyal customers. And I talked about the service profit chain, I think, in the last topic, so you can understand, how that can really kind of evolve, and working these two together in the service profit chain. And then the financial piece, how to succeed financially, how should we appear to our shareholders? And I don't want to dismiss, the triple bottom line, because in here and in these 4 areas, we still should be talking about planet and people as well, so social responsibility and environmental responsibility. So never want to get away from that. And then you're only as good as your internal business processes. And if your internal processes can't meet the needs of quality and delivery and responsiveness and functionality for services or whatever, you're never going to make it, right? But look how this is. Look what's in the middle. This is driven by vision and strategy. So it's the vision and strategy that drives these 4 areas. And now let me kind of connect, when I asked you I said we're going to connect goals to KPIs, or key performance indicators. So what do you do in your internal business processes? Well, you set up key objectives based on your vision and based on how you want that company to succeed. And to be able to know what gets measured gets done. Well, what measures? That's where the KPIs come in. The KPIs are measured in terms of meeting those objectives, so if you're making progress or not. But hang on. So now you set those objectives, and in those objectives you've established some targets. And so you have a target that you have to reach, and now you have a measure showing how close to the target you're getting. 2 things. One, now that's business control processes, which we're going to talk about in this webinar. And it's also, if you take a look at, outside, you want to compare your company to outside, and you'll go into a particular industry and look at internal business KPIs on average, and you compare your results to that average, which is the industry standard. And that's called benchmarking. And we're going to talk about that as well. And we're going to, you're going to have to do some benchmarking in the cupcake assignment, right? And then this other part, is initiatives. So what kind of, maybe short-term plans, action plans, different, let's just use the word, initiatives that you need to undertake to satisfy those objectives, to achieve those objectives. And then you use the measures and targets, to calibrate your way into getting to the outcomes that you've set up in your objectives. So that's really a key piece here in terms of, we're going to talk about the business financial controls, but the balanced scorecard really is the key mechanism to help you put this all together. And oh, by the way, when I facilitate strategic planning, I will actually break down our approach when we look at the environmental scan of what's going on with the customer, what's going on financially, and what the possibilities are for the organization. What's going on in terms of disruptive technologies, and how the organization has to meet certain core competencies to be able to to be able to thrive and to have competitive advantage. And oh, by the way, what's the gold standard in some of the industries that you're competing in, so that that you can do the right things to be able to compete properly. So that's where that is. And then here's the actual template that I want you to use. And then again, for the the gingerbread house, focus more on just the finances and the processes. And if you go through Professor Power's video, she's going to tell you how to, set the score and look at mean performance to be able to do that. Okay, I think that's all I was going to cover, on this piece. So let me go back to where I was. Okay, so here's where the whole KPI thing, or key performance indicators, ties in to the to the balanced scorecard. And really what you're doing in terms of financial management through the 4 functions of management, remember that, and I think topic number 1, planning, organizing, directing, and controlling. What you're trying to do is manage profitability, expenses, cash, and credit, so the organization has the ability to fund its operations. And we're going to talk about financial ratios in these areas as well. And again, we're going to look at the 15 financial ratios to look at things. That doesn't mean that a business will have to look at everyone. Again, it depends on what their key performance indicators are. It depends on what the vision of the organization is to find the appropriate KPIs, and then define those or measure those in terms of some their actual measurement indicators that sometimes gets down into doing financial ratios related to those KPIs to be able to see if you're winning or losing. Okay, so that's where that piece is. So and again, be mindful of the highlighting that I'm doing here. All right, so these are all highlighted, so which means they're pretty important areas that you want to study, for test number 2. So the areas of financial management are treasury management, and that's where you manage cash flow, and cash is king. I'm going to talk about that. But look at accounts receivable. That's what you're taking in for selling your products and services. Accounts payable, that's how you're paying, your expenses to be able to be in business. And lo and behold, going through these really gives you a big part of what your cash flow is all about, right? So that's one thing to know. The capital structure management, here's another area where you need to manage, the combination of how much debt are you carrying and what kind of debt versus how much equity that you have, like how much, how many shares that you have, and how much money you have in the bank, right? And then working capital, and I talked about working capital quite a bit in terms of inventory, and working capital. If you've got a lot of inventory that you're not moving, that's money that you could be using to be reinvesting or paying shareholders or whatever. So on the working capital management, you're analyzing financial ratios, and you want to create strategies to ensure that your assets and liabilities are managed effectively. And then risk management. And 30, 40 years ago, risk management was just something that they did in the audit department in accounting. In today's world, everyone is responsible for risk management because of the complexity of businesses and global trading and logistics and everything else that we need to deal with in today's world. Fraud, internet access, all those things. And what risk management is the process of preserving those earnings and assets and minimizing the impact of any loss. And again, just understanding where the market is going, where the external environment is going, and tracking that to see that, what are some impending risks that are going to, work against your business, and how to get ready for it and how to mitigate your risk, essentially. So this is an area that you really need to look at. Again, if you look at the financial aspect, you can see establish a profit goal. Well, lo and behold, in this particular illustration, that's termed an objective. determine the volumes of sales revenue needed to make that profit, estimate your expenses for reaching that volume, estimate profit. So there's a big piece of planning that needs to go in, and we're talking about the 4 functions of management again. So now you're planning, going through, and now there's various different metrics that you can use to know how well you're doing when you're when you want to calculate how your profit itself, and look at all these pieces here, and we're going to talk about most of them. And again, there's only so much time in this webinar. You're going to have to go back to your your main 70+ slides in the topic 6 and go through some of those key videos on the finance piece, because I'll tell you that 2 of the ratios that we're covering out of those 15 are going to be subject in a test. So so you need to know a lot more about that going on. Not going to talk too much about break-even analysis, but you can see that if you can accelerate your sales revenue, you'll be able to lower the break-even point. Like here's where you're looking at your sales revenue, and you're looking at your total cost, starting at fixed costs versus your variable costs, and you may be out here in a large volume of at this particular volume of sales, and now this is just the point where you're starting to create profit, where you're bringing in more revenue than what you're putting out in terms of revenue versus expenses, and again, if you can accelerate those sales, well then you'll do that a lot quicker. So that's what you need to know about this. Sales growth, here's the formula. These slides are pulled right out of the topic 6 deck, so that they're important to understand what this is all about. And again, the challenge, if you're growing your business, it's the point that I made. It's declining. Costs keep increasing over time, inflation, so that you got to increase your revenues. You got to look at decreasing your costs. You got to improve your existing offerings, and you got to create new offerings to stay in the game. So that's the challenge in this business, and it's all about cash flow. And your lender is always looking, how well you're doing on your financials, and if they can see your cash flow starting to peter out, which means that you've got less money coming in that's going out, or if it's decreasing, they know that you're heading into a problem. If it's increasing, then they know that, hey, you're doing some things that are successful, and they won't be worried about their loan. So you'd really need to understand that. And in my day and age, we always used to say, cash is king, right? And that's what keeps the business going. And again, what you need to understand too is that if you're looking at, if some of you are looking at starting your own business, choosing the right accountant will do a great service for you. And what you want in your accountant is not just an accountant that knows how to do your tax returns, but an accountant that really understands your cash flow, that really understands, cost accounting and how to improve your profitability. And that kind of accountant is called a controller. Sometimes it's spelled, traditionally as C-O-N-T-R-O-L-L-E-R, but C-O-M-P-T-R-O-L-L-E-R. And that's really where you really gain some insights. And running my own businesses, I had a controller type accountant. And every quarter I'd sit down with that accountant, and I would not only find out, where I was going, but I was getting coached and advice on where to improve my costs, where to take a better look at where I can improve my revenues, those kind of things, and gave me a better perspective in terms of looking long term and understanding my business, knowing the business, understanding the numbers, so that I know I could stay profitable. Okay, so which brings us into the control cycle. And the control cycle is, let me just flip back to this, all right? Control cycle is, let's go back to, this little drawing here. Army, come on. Sorry, I overshot. Okay, let's find this. Okay, Back to these, these little columns here. The control cycle is, well, hey, you've established targets. You've established, the targets through the objectives or the goals that you set, in your particular area of business in terms of finance. And then you've established which key performance indicator that you're going to use to determine how well you're doing in reaching that target. Right? That's what this control process is all about. And again, the control cycle. And again, this is highlighted, so it's important, right? And what are you doing? Well, there's different kinds. Here's the setup. You measure the actual performance. Okay, so what's being measured? KPI. How's it being measured? Because you want to know, because if you're not measuring it often enough, or if you're not using the right ratio for that KPI, then you're really not getting a true sense of how you're doing compared to the target. And then you compare to a performance standard. And what happens is, there's always going to be variation, in your results. And what you do is you accept a certain amount of variation. So you will establish an upper level and a lower level. And when you get beyond that, then you know that, hey, you've got some root causes that you have to deal with. So if it's an acceptable range, it means, hey, it may not be exactly where you want to do it, but it's within a range of acceptability, say, for your customer in terms of, percentage of quality on a particular item, you're okay. And you're going to compare that to an industry benchmark, so, and you're going to need to do that in the cupcake assignment. You're going to have to compare your financials to the food industry, and lo and behold, I'm giving you the actual numbers to compare to in this presentation, right? So we'll go to that, and then you compare to previous performance, so you can see, am I doing better than last year? Am I doing worse? And if I'm doing worse, well, this is not acceptable. What can I do? So that's how this piece comes together. But what actions can be taken, right? So let me just read this. So the control is the process of monitoring activities to ensure that they are being accomplished as planned and correcting any significant deviations. But there's ways of doing corrective actions. And the basic corrective action, and you notice this is all highlighted, the basic corrective action looks at how and why performance deviated to correct the source of deviation. All right, you focus on the root cause, focus on the source. Sometimes you look at immediate corrective action, corrects the problems at once to get performance back on track. So let's just talk about an assembly system, and one of the machines in the middle of the assembly line breaks down. Well, you want to fix that right away because the whole line is going to be shut down. So that's an immediate corrective action. Okay, so here's the the piece where I talked about the target and the measurement. So again, you start and you set goals for your particular functional output, whatever that is, or quality of your product or whatever. And again, in the illustration I give you on the balanced scorecard, that we talked about objectives. So it depends on what level you're operating at, but goals, objectives for this example is quite similar. And so that you take a look at what the standard is, and the standard might be what the industry benchmark is. How's the average of the industry doing? And I want to be at least as good as that, if not better, right? So that's the standard that you're going to benchmark against. And then, so what you do then is that you have a standard and you're measuring what's coming out of your function, maybe it's production or maybe it's sales or whatever it is. And then you compare the actual performance to the standard. So you're comparing and you're saying, is the standard being attained? Yeah, it is. Okay, well, the course of action is I do nothing, right? Because, hey, I'm meeting the standard, that's great. Okay, but if it's not meeting the standard, is the variance acceptable? And I told you have these upper and lower ranges of what the outcomes should be like. And if it's within that level or that area of variation, you're okay. And oh, by the way, you can statistically look at this, and it's called statistical process control. because when you get outside of those levels, that's when you have a meaningful thing that you have to deal with in terms of like root cause problem or whatever. All right, you don't have to know that, but I just wanted to throw that one in. So is the variance within those levels acceptable? Well, you say, yeah, it's okay. Well, you don't have to do anything. That's a course of action. But if it's not acceptable, if it's outside that range, say it's higher, you've got more defects on your production of your widget than what the industry is for producing that widget, then you got a problem. Okay, so then so what you do then is you say, okay, well, base though, is my standard still hold? Is that what I'm looking for? And if you're saying, yeah, my standard still holds, okay, well then you say, okay, that deviation, yeah, we need to identify the cause for that variation. That's a course of action, right? And then what you do then is you correct the performance. That's a course of action, and then you measure again, right? But if your standard is not acceptable, you revise the standard. And then sometimes organizations, they put more quality into a product than the customer can appreciate. And they're saying, we'd still make the same amount of sales if we drop the quality standard by 10%, because the customers aren't fussing about that. And you'll see that on washers and dryers. They put like a gazillion types of functionality on those washers and dryers. And I'm sure that most householders, they only use 2 or 3 features. So if somebody came in with the key features that they're really looking for and could produce that at a lower standard of functionality and at the same quality, they'll do really well. So that's the actual control process. And again, this is highlighted, so it's really important in what's going on. And there's really 3 areas of control. And you notice there's a little gold key here too, so that's important. So there's feed forward control, and what that is that's measurement that can actually anticipate a problem. So it might be, sometimes it's what they call a proxy measurement, and if that's not quite right, at the end of the line, something's going to give, and you're not going to get what you need at the end of the process, and so it gives you an advance notice of what's going on, so you can prepare for that. And then there's concurrent control that corrects the problem as they happen, and you should know a little bit more about concurrent control. But this example I gave you about a machine in the middle of an assembly line breaks down and has to be fixed like right now, that's concurrent control. And then feedback control, that's like managing by driving in the rear view mirror, right? Because what it is that feedback control is historical. So like weekly revenue. So the monthly revenue for August was $30,000, and you're in October or September. There's nothing you can do about that, But what you can do is you can trend, that monthly revenue in September every year, and you can see if you're doing well or not. And the trending will give you some indication of what you need to do to improve the process. Okay, and here's sort of the this is my view of what happens here. If you can catch it ahead of time, you don't spend as much money, right? If you do it right on the fly, well, then you will spend a little more. But if you wait at the end of the day, and find out, like historical things, well, that's going to cost you a lot of money. And just take a look at the car manufacturers that have to do a recall of 100,000 vehicles. I mean, that's feedback control. Okay, if they would have had some sort of feed forward control and maybe better testing or whatever as a KPI, then they wouldn't have to spend all this money in recalls. So that's what that's all about. Okay, I talked about controller type accountant. Don't need to do that. Now we're getting into traditional financial controls. And again, these are important. You can see that they're highlighted. I'll turn your attention to economic value add. Now, there's 2 kinds of value adds. One is economic value add, and one is market value add. So what economic value add is, it measures the corporate and divisional performance, so that if they're generating negative economic value, that means that the company's not generating value from the funds invested into the business. So basically, you have $1 million that you've invested, and if you're getting less than bank returns, from your process, then it's telling you made the wrong decision. You're not really adding enough economic value to make that business viable. You might as well have just left the money in the bank, right? So that's what that's all about. And you can see that. So EVA is the operating profit minus tax minus the annual cost of capital. And this has to be positive to be able to show you that, yes, you're making positive economic value, and that's key. So that's one way of looking at it. The next way to look at it is, how does the market appreciate what you're doing? And the stock market's estimate of ability to increase the shareholder value. So they'll look at consecutive years of economic value and then say, yeah, the market value is that their stock is worth a lot more because it's growing in economic value add. So that's a real good buy for the stock price, because you're gonna get good share returns, and the value of that stock is going to keep going up. And so here's the formula for market value add. So those are really important to know. Now I'm getting into the financial ratios. So we talked about debt versus equity. We talked about cash and whatever. So when you take a look at these financial ratios, they give you insights in how well a company is performing. That's what it's all about. And the second group here is they assess solvency, which is how much you're in debt, versus liquidity, how much cash you have to be able to how much cash flow that you have, and how you can you need liquidity to make different moves. It's money that's available to be able to reinvest in a process, or take on a new project or whatever. So this is how these ratios come together. They're performance ratios, and they look at the return and the profitability of the organization. And then asset utilization, how well are you using those assets? Are they doing what they're, for the investment that they made? Are they doing well for you? And then on the financial leverage, leverage is debt, right? The more in debt, the more leveraged you are. So you look at those financial leverage ratios, and you look at, how bad are you in debt, or how good are you in debt? And then, how liquid is this business? How much that you have to, the capability to reroute assets, or, liquidate assets, or, get cash to be able to do something, right? So that's what that's all about. So this is kind of a precursor to these 15 ratios that you're going to have to become aware of and know how to calculate. And this is just an add-on here, just to remind you what liquidity is. Refers to both enterprise's ability to pay short-term bills and debts, and a company's capability to sell assets quickly and raise cash. So it's all about cash. We talked about cash flow. And then solvency refers to a company's ability to meet long-term debts and continue operating in the future. So that's speed. So what I found here is this is the Duke University. I've given you the link, and it not only will it'll cover a lot of these ratios. It won't cover all the 15 ratios, but it really gives you an idea of, okay, in liquidity, the quick ratio, what's its purpose? What's it needed for? What is it telling you? And so that you can get an idea of what these ratios will do for you, and really take a look at this. This came from another piece of information that I pulled. If you look at the way this is structured, lo and behold, structured the same way. Look at liquidity, debt management, asset management, profitability, return to investors. Okay, so it really gives you a good sense. Here's the link. You can go into there and get that. So now we get down to the crux. These 15 financial ratios you're going to have to calculate for your cupcake assignment. So really, you need to understand, how to calculate the ratio, and they're not, it's not rocket science. It's just a basic, division type of calculation. And again, when you do this in the assignment itself, I want to see you show me the formula, show me the calculation, and show me the outcome. In case, you use the wrong number or whatever, I'll still give you marks for, flowing through where I can see that, hey, you've gone through this. And understand, net profit to owner's equity, this is a really important one. Notice, see that little yellow arrow? That's really return on equity. And learn about that, but learn how to calculate these ratios. You're going to need these 15 ratios to the cupcake assignment, and work that through. And again, this gets back to the KPIs that you use to be able to know in your own business, how well you're doing. And again, it depends on what your vision is, what your key goals are for the organization, what business type it is, what type of industry you're in. It's all going to change. So the answer is it depends. Okay. Okay. So what, getting back to the balanced scorecard, we said that you're going to have to calculate a ratio and then compare it to a benchmark. An industry average basically is what the benchmark is. And this link takes you to, a Service Canada link, I think, in terms of financial performance data. So you can see in particular industries, and there'll be numbers for them, what you need to worry about is SME 722 for benchmark of restaurants. All right, and take a look at, where these ratios lie in terms of a benchmark. What are they? And what I've done is, I've actually found them for you. So here they are. That's the link to get to them. So when you do your cupcake assignment, you're going to calculate net profit to owner's equity. And, if you're lower than 23.17%, it's saying, oh, your business isn't doing too great. If you're running at it, well, then, let's go back to this piece. If in the control process, if the standard is being attained, well, your course of action is do nothing. But if the standard is not being attained, and the variance is not acceptable, well, then you need to figure out what you're going to do about it. That's what this is all about. So I'm trying to tie this all together for you. Okay. And so what you're going to do is you're going to calculate these 15 ratios. And again, go back to the videos and the topic to be able to understand how to do that. And then in the cupcake assignment, you're going to compare your numbers to the benchmarks of restaurants, small and medium enterprise 722, to see how you fit. And that's really going to tell you how well you're doing and how you should be controlling your financials. Right? So that's where that's coming together. And here's a little bit about benchmarking. So the best way to understand how well your organization is doing and where and how it could perform better, right? That's what you're doing here. You're going to calculate, what you're doing for the cupcakes. You're going to compare it to the benchmark, and then you can realize what's being said here. And here's an example, just in hospitals, there's certain KPIs that they look at, average cost of a journey of a patient, or outcome index versus the cost of journey. So they have their own KPIs because they're a different business, they're in a different industry. And again, some hospitals want to be, total excellent performers in a particular area. So they'll emphasize certain KPIs that will get them there, right? So that's what benchmarking is all about. And lo and behold, look at this, all this highlighting, you got to know what benchmarking is. So it's the search for best practices among competitors or non-competitors that lead to their superior performance. And it's not just financial benchmarking that you do. You can do all kinds of benchmarking. So let me give you an example. So if I'm in the retail business and I really want to cut my inventory costs, and I want to understand, just in time inventory, so that maybe I've got a place of sale software that tells me as soon as that shelf empties, an order will automatically go to a supplier to fill that shelf, right? And if I wanted to find the best company that does that, and I may be in the I may be in the sausage business, but that doesn't mean I have to look in the sausage business. I can go to Walmart because they're best in class when it comes to that kind of capability. And some of the technology that they have is military grade or better in terms of radio frequency devices that they use, in their flow, so they know where the inventory is and all those things. So again, you may not have to go to the next sausage maker. You could go to somebody else that's entirely in a different business that's best in class in that particular function that you want to improve, right? So you connect best practices to strategies and goals. And oh, by the way, something that really works well that you're benchmarking in another company may not work in your company. I've done this. I've actually worked with consultants who have done benchmarking for the telecom company I work for. And essentially, you take that best practice and then you look at it very closely to see how well, what they're doing fits with what you're doing in your organization. And if the fit is there, then you actually test, that best practice in use and see that it works for you. And then if it works for you, then you apply it, and then you can up your capabilities in that particular area. Okay, so you identify best practice throughout the organization. You develop best practices, reward and recognition systems, communicate those best practices, knowledge share about them, and nurture those practices. So this is a key part of continuous improvement in the total quality movement. So that's where you need to understand that. So I went through the balanced scorecard. I talked about that. I want to talk about risks a little bit, and the type of risks. Some are just speculative risks, uncertainty that a voluntary taken act will result in a loss, and so that you can, you're not quite sure, what's out there, but you're watching. And then you'll kind of sense that, hey, I think this is going to be a problem, so let's get ready for it, in terms of what's coming down in the marketplace. It may be interest rates are going to be pumping right up, and that means less sales for you. So if you do something wrong because of that, you're going to get a loss. But then there's where there's uncertainty associated with a situation where only loss or no loss can occur, and that's really, the pure risk is that somebody slips on, on your sidewalk in front of your business, that's a property risk, that's a liability risk. So you don't know if that's going to happen. So how do you, the best deal for pure risk is, you insure against these, right? So there's ways of mitigating that risk depending on the type of risk is what they're saying. So what do? You identify and understand those risks, you evaluate potential severity of risk, and then you select the methods to manage or mitigate that risk, then you implement the decision and review and evaluate. But here's the strategies. One is that avoidance. Well, you can, some companies say, you know what, we're not getting into let me see, the sale of explosives. Why? It's just too risky. We're in the construction business. We supply construction supplies. Explosives could be one area where we could supply it, but we're just not going to do it. We're not going to take on that risk. That's avoidance. Then mitigation is saying, all right, let's look at drug use in for truckers. What do? Well, then you want to reduce the possibility. So what are you going to do? You're going to do driver training. You're going to do driver intermittent drug testing, and also you're going to do audits around that so that you make sure that there's no drug risk in your truck driver operation. Then transfer. Well, transfer is that insurance or contract. So that you buy insurance. So if something goes wrong, well, then the insurance will cover it. And then assumption, financial loss intentionally. So the thing is that you're saying, oh my goodness, for the business risks, you know, they because we want such a they want such a high deductible. You know what? We'll self-insure. I mean, that's what assumption is. You know, we'll take that on because we just can't afford the those premiums. So that's that's intentionally. So again, you need to understand what the balance sheet is, and you need to work through a balance sheet in the cupcake assignment. And the balance sheet really is the strength of the business. And understand that a balance sheet as well is it's a snapshot. It's what was assessed at that point in time. And that's why companies do them at least once a year, to be able to see, and then they can see how their balance sheet is changing year to year. All right, and here are all the pieces in there. And by the way, if you go to this Google Doc, this is the balance sheet that I want you to use to be able to put this together. And again, the video in topic 6 will show you a lot about how to complete the balance sheet, and so that you use this template to put it in your assignment. And then understand again, like what are current liabilities? Well, there's short-term securities, say 12 months or less. What's long-term debt? Well, that's at least 5 years. What's shareholder equity? Well, it's people own shares in your company. There's common stockholders and preferred stockholders. You don't have to know all these details, but I just wanted to give you this as a look. The income statement shows a company's revenues and expenses, profitability over a period of time. It's basically your profit and loss statement, and then you'll need to do a particular income statement, and again, use this template and show everything on this template, even if these are zero. All right, and you'll have to learn about what non-operating income and non-operating expenses are all about. We went through this calculation already, and again, now we're into other profitability measures. What EBITDA is, it's amortization, refers to expensing these intangible assets. This is not so important in what you're doing, but I just wanted to give you that as information. And then just understand how to finance your business. So you can debt finance, so you can do short-term loans, short-term securities, intermediate, long-term loans, and then equity financing is that you can issue shares, and that way people will give you money to start your business, and then you pay them a share return, and they can enjoy the growth of your stock price as well. Okay, I think that's we're getting low in time here, so I think this is yeah. So we're near the end. I want you just to kind of look through these, but you can see that there's not too much highlighted right in here, but it's good to know about. But the whole idea is to go to the videos and learn as much as you can on creating a balance sheet and creating an income statement for the cupcake assignment. And it's going to be fairly basic that you have to do this. And if you need any additional help, send me an email, and I'll be able to help you with that as well. Okay, and that's it. So any questions at all? Okay, yeah, anybody can unmute and ask me a question. And let me just go to the chat here to see if anything got put in the chat. Okay, I don't see anything in the chat, but the whole idea is, focus on your participation activities as a group. Keep your information. They're building blocks. Use the same templates that really help you in a cupcake assignment, and pull up that cupcake assignment description as soon as you possibly can with your group to discuss, what needs to be done, so that I can clear up any kind of any misconceptions about what you need to do, and we'll go from there. Okay. So if there's no questions, I'm just going to sign off. wish you the best in terms of reading week, and get caught up, and get some rest, and get some enjoyment as well, so you can kind of relax and release some of that stress. Okay, and we'll talk to you soon. Okay, take care.
Thanks, Gary.
All righty.
Thank you.
You're welcome.